Opening range gap fills, as well as inverses and reverses, just trade opportunities off of a gap up or a gap down open. Also irrelevant if the market opens within the previous session's range. We can also get many trades out of that. But specifically, we are dealing with the gap up or the gap down open. So first and foremost, let me say that this trade is much more reliable Tuesday morning through Friday morning, because participants in the futures and commodities markets are generally holding overnight. Now, it has worked many times on a Monday when the overwhelming majority of futures traders cash out and are not holding over a weekend, but longer term players are still holding, therefore defending positions. Now, gap up or a gap down is simple. It refers to the previous day's range only. So for example, I drew this range in these high volume areas, which are the orange levels. Those are all signal calls. Black lines are all signal calls. I drew this Wednesday afternoon, December 24th at 1:30 in the afternoon at the close of gold. So all of these levels for every market that I select trade levels for are all done by 6 p.m. Eastern Standard Time the day before. So they are for use in the overnight, the pre-market, and the pit session. But gap fills, either a gap up or a gap down, are only for pit session use. So essentially what you're looking for, the larger the gap, the better. So for example, you would love a gap up here, you would love a gap down there. Why? Because you're going to get more trading opportunities that are based on actual volume traded, not anything else. Meaning what? Actual contracts that have traded hands in previous days, and more importantly, the most recent day, which is the prior day. Those are the most valid because that's when trading most recently occurred. So before I go into nitty-gritty about the actual trades and what they look like themselves, let's say the market opens gap up. You are looking for the market to start selling off. If the market opens gap down, you're looking for the market to start going up. Why is this? Because this is based upon the immediate trend only, which is fear and greed. As we all know, futures is a zero-sum game. You only need one more aggressive buyer versus passive seller to make the market go up, and one more aggressive seller versus passive buyer to make the market go down. Well, there are two targets you're looking for. One is the point of control, which is always going to be these yellow letters, which we publish as well every single day, or the close of the previous day, which is the most recent price. They are both equal in importance. And depending where you open, let's say if you open gap up, the close of the previous day will be your first target. Once you get through that, the second target will be the point of control. Conversely, if you open gap down, your first target is going to be the point of control. And then if you make it through that, the close. Now, traditionally, gap fills are considered complete. Let's say in the case of a gap up when you reach the previous day's high, or the case of a gap down where you reach the previous day's low. This is faulty. It's always been faulty. It's a lazy way out. You're looking for the most heavily traded price or the most recent price. Why is this? We are in a defined uptrend in gold. We closed at the higher end of the range. Generally, that is going to tell you that buyers are in control. Well, if we open gap up, the overwhelming majority of professional traders, let's say in this case, we closed at 45.07 and we opened at 45.50, You just woke up with a 43 point, $100 per point winner, $4,300. Professional traders are going to take that money and close out. Well, what is everyone else on the other side of the ledger who was holding short yesterday going to do? They are also going to start hitting the sell button because they have to get back to break even. This could take all day. This could take minutes. Conversely, if the market opens gap down, all of these people who were holding short at 45.07 just woke up with a monstrous Christmas present in, well, December. And let's just say that they opened up with a 60 some odd point winner. They are going to hit buy orders. They're going to close their positions. And what are all the people who were long going to do, who all opened well below yesterday's range and where they were holding? They're going to start buying as well. This could take all day. This could take minutes. I've seen both happen. There are specific rules for that. We can always get into that later. Now, we are counting on fear and greed. That's the real trade. Now, where to get in? If you open gap up, you're looking for the market to head lower and go short below 45.2690. You can also go short below 45.1790. You can also go short below 45.1320. Your target being the close, which came first. Now, the overwhelming majority of the time, 80, 85 to 90% of the time, once you hit that price, the market's just going to go sideways and do nothing. If the market starts heading lower and you get accepted below that edge at 45.0140, your target is now the point of control. So in this one scenario, you had at least 1, 2, 3, 4 opportunities to get short to the close and a 5th to get short to the point of control. Conversely, let's just say we open here, gap down below the previous day's range. You're looking long. You would look to go long above 44.6680. You would look long above 44.7440. You would look long above 44.9050. If you got through the point of control, got above that level and went higher, you're looking long at 45.0140. That is 8 possible entries for one market. We publish for 6 markets. Generally 5 where most of the action is going to happen because the British pound we just use as a placeholder. Tremendous amount of actual opportunities each and every day. They are also there waiting for you. All you have to do is wait till the price gets there. We are the only people in the business that does this. No one else even has any clue of what I'm doing. Now, the trade itself. Let's say you open gap up. You are looking for an opening bar gap fill. What does that mean? In the gold commodity, we can use a chart, at least we do, of either 144 ticks or 233 ticks. It's irrelevant. It really doesn't matter. This can be done with minutes, Renko bars. It doesn't matter. What does matter is each person's risk tolerance. We have our own specific method for managing risk on a set amount of points per bar, including your entries, but let's just bypass that for the moment and show you exactly the mechanics of how this works. So let's say you get an opening bar and it opens and it closes. We would look to place a sell stop 2 ticks below that bar. Once we get pulled in, we will put a protective buy stop 3 ticks above that bar, and we are looking for the market to move straight down back to the previous day's range to fill the gap. According to our method, we will move to break even as soon as possible. These trades should just go. And if they don't, there is a 10 to 15% chance of a gap and go, which means the market just opens and goes straight up if you open gap up. Or if you open gap down, it opens gap down and just goes straight down. There is always a possibility of loss. Again, what are you doing? Opening bar gap fill. You are waiting for the first bar to close. You are then entering a sell stop. When you get pulled in, a protective buy stop. As the market moves in your favor, you will move your stop according to our method, whether you're using a 1 bar or a 2 bar stop. Conversely, if you get a gap down open, and we'll just go down here because it's easier that way, you're waiting for the first bar to close. Once that first bar closes, you're going to place a buy stop to go long. Once you get pulled in, you're going to put a protective sell stop in. As the market moves in your favor, you are going to move your stop, your trailing stop, according to our method. Now, just to give you an example of risk management, if the market opens gap up, you do not get pulled into a trade and it starts moving higher and it moves more than 3 points away from your entry, the trade is disqualified. You now have to wait for price to come back through the open, through the low of the day at that point, start heading lower, and then we have trades available to us to get short. This happens all the time. Conversely, if you're looking to take an opening bar gap up trade, long, the first bar closes. If the market starts moving lower and it moves more than 3 points against you, which is our maximum risk for most traders on gold, the trade itself is disqualified. If the market spins around and starts heading up, we have many trades we can use to get long, to get back to the previous day's range. Now, let's say that happens. The market opens up, the market opens down. It heads up, disqualifies you, more than maximum risk, heads down. We have trending trades available to us that could appear anywhere all the way down. Market opens gap down, the market starts heading lower. More than $3 of risk is achieved, the trade is disqualified, the market spins around, it starts heading up, we can take trending trades the entire way up. What are the strongest trades that we have? The strongest trades we would have after that opening range gap fill trade is achieved, you would look short with reversals or inverses, which is exactly the same trade. It's just two different names to differentiate what the actual technique is for teaching. On the way down against actual levels of support and resistance that I have identified the previous day. Conversely, if you were to open gap down, you have all kinds of trending trades you could use, but you would also look long here, 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 here. The strongest possible play that you have is a gap fill, a trending entry, or a reversal or inverse back to the previous day's range. If you have any questions, I would be happy to explain them to you. Just let me know.